Today, we will talk about how to use life insurance as collateral for a loan. Let's have a look at the details. A borrower will assign a portion or their insurance policy as collateral for a loan in the case of death. This doesn't mean that you can use life insurance as traditional forms of collateral. It's only a measure lenders take to protect themselves against the potential death of the borrower. This means that part of the insurance proceeds are used to pay the loan principal and interest. In the event of the death of the borrower, part of the death benefit proceeds are used to pay off the loan balance while the remaining amount goes to their beneficiary. The first step is to understand which policies are best collateralized. If you're trying to use the value of a life insurance policy to help secure a mortgage or other type of personal loan, the lender might prefer if you have a whole or permanent life policy with accrued cash value. That cash value makes the policy a tangible asset, like a building or vehicle. The second step is to know your other obligations. If you already have a life insurance policy, you might be able to use that. In addition to paying back the loan as agreed to in their agreement with the lender, you're also required to keep current on the premiums of the life insurance policy for which the lender is an assignee, and not let the policy lapse. Staying up to date on the premiums of that policy is a condition of the loan, and you can expect the lender to check. The third step is to be prepared when the loan ends. When the loan is paid off, the assignment terminates, meaning the lender no longer has a claim on your insurance policy, and the lender will need to provide you with documentation attesting to that. If you don't get this documentation, follow up until you have it in hand. The fourth step is to pick the right policy beneficiary. A common and potentially very costly mistake is to make a lender a beneficiary of a life insurance policy, rather than an assignee. With a collateral assignment, the lender gets first dibs at the death benefit money up to the amount of the outstanding debt. Then any remaining funds are parceled out to beneficiaries. If the lender is the beneficiary, though, that would entitle them to the entire death benefit, which could leave the policyholder's heirs with nothing. Thanks for watching our video. Please don't forget to subscribe to our channel.